Hello, guys. So today's our guest is Jason Choi, who is co-founder of Tangent. It's an angel group who invests in crypto startups, and as well, he was a partner before at Spartan Capital. Great to have you here, Jason.
Yeah, thanks so much for having me, Anna.
So can you tell your story? How did you get into crypto? Which year was it?
Yeah, so I love that question about which year, because it tells you so much about kind of what the person's view is on crypto. So I came in the ICO wave back in 2017 when I started noticing a lot of these, ICOs started happening. And I noticed that, okay, a lot of these things are not necessarily legitimate products, but there's a lot of speculation. But under all the speculation, there's inklings of interesting ideas. So these are ideas like decentralized communities. I think back then DeFi wasn't really a thing yet, but there's this hint of a thing called open finance. And then some people were talking about rights ownership through things like NFTs. But then the thing that really drew me into this space is this idea that venture capital can be completely disrupted by just a decentralized way of fundraising, which at that time was ICOs, and then now there's DAO fundraising and so on. And as someone who wanted to become a VC earlier in my career, that's something that really spoke to me. So I kind of dove deeper and tried to explore more. And then, and that was almost 5 years ago now. So since then, I've joined up with my partner at the time at Spartan Capital called Calvin. So he used to be a partner at Goldman Sachs and then led a $6 billion hedge fund in New York. And then he spun out to kind of do his own fund called Spartan Capital. And I was very lucky to have met him in the very beginning of the fund. So we kind of grew the fund together from a relatively small $10 million experiment to almost $500 million in assets under management by the time I was leaving. So we grew one of the first kind of institutional funds in Asia. And then after that, I decided, hey, it's time for something new. So I spun out and started Tangent, which is, as you mentioned, an angel collective of some of the more experienced founders across different verticals in crypto.
And did you have any experience before in Web2 VC investing, or what was your previous background? What did you do?
Yeah, so I actually did. So back in college, so I went to Wharton School of Business in Philadelphia, and there I helped started a fund called Contrary Capital, which was a decentralized venture fund. So they used the word decentralized, but they actually have nothing to do with crypto. And the reason why it's decentralized is because it had pockets of essentially analysts or partners across 120 universities in the United States, and we were sourcing deals at the very early stages. So we're trying to find those people who are maybe getting their degrees, maybe bachelor's degree or MBA degrees or master's degree in engineering, and trying to really intercept them when they have the idea of starting a company. So really in the really early stage. And that has always been my DNA, right? In terms of really early stage investing, working with founders and ironing out product market fit, talking to the first customers, making the first hires. And that's something that I'm bringing over to Tangent as well, which I'm really excited about.
So how is Web2 investing different for you from Web3 investing?
Yeah, I think the biggest part is the existence of tokens. That's probably the massive, that's the biggest difference, because on one point for investors, it offers initial liquidity, earlier liquidity. So the return profiles is slightly different. The return horizon is slightly different, but also in terms of managing the company from the founder's perspective, it's much more similar once you have a liquid traded token, much more similar to managing a publicly traded company than a startup. And if you have the messiness of a startup coupled with the transparency of a publicly traded company, the two things shouldn't be put together, but in crypto they are, and it makes for a world of difference between how a Web3 protocol or DAO is run versus a startup that can actually remain in stealth for months or years before they launch a product.
And now you started Tangents, and it's like you mentioned, it's Angel Collective. So why did you decide to move out from traditional VC to just Angel Group, and why do you consider it to be more efficient?
Yeah, so I have a lot of respect for the VCs in this space. I think especially in bear markets, I know in bull markets, people like to talk about how VCs are dumping on retailers and all that. For some funds, that is true. But for a lot of the funds that I talk to, that I respect, they are really there to fund innovation when no one else is. So I have a lot of respect for that model. Now, at the same time, I do notice that a lot of the funds have grown significantly in size, right? So the median crypto fund, I think, has grown almost 40x at least in assets under management since 2018. So what this means is they have to basically spray and pray a little bit more. They have to invest in a lot more deals in order to deploy all the capital. So what ends up happening to founders is that the hands-on support that were promised to them by a lot of VCs who talk a big game on Twitter, they don't get that support anymore. And in the first 3 to 6 months after your first round, those are the most important times for founders to have support, to tap into the networks of the investors, but many of them are not getting the support anymore. So I thought to myself, okay, what is the best way for me to kind of fill this market gap? Is it by raising my own fund, or is it by just being an individual angel? So at that time, when I was kind of pondering this solution, I started noticing that a lot of cap tables in DeFi and NFT deals were filled with a lot of angels. And a lot of these angels are not just, people writing checks, right? These are like experienced founders and operators and companies, bringing with them years of insight and networks to founders they back. And it seems like across the board, relative to the amount of money they put into startups, the value they add is punching way above their weight class. So I thought, okay, maybe there is a way to really organize this group of just founder angels and support them in a way that maybe they haven't been supported before. So maybe helping them do due diligence, helping them source deals, helping them do reference checks for founders, which are things that angel founders simply do not have time for because, they're busy running their own companies. So that's kind of how the idea for Tangent started. So I'm really excited to start this with my partner, Daryl, who also came from another Asia-based crypto fund, and also with our 6 mentors who are all either operators or founders in some of the leading protocols out there today.
So what hands-on support do you provide for the projects, and what kind of support do projects really need when they're early stage?
Yeah, so I think in the early stage, the most important thing is probably product market fit and then hiring. So what we help with product market fit side is not only do our founders come from some of the most used protocols in crypto, so they can offer the insights into how they were able to achieve the product market fit. We actually also go out and do market research for some of our portfolio companies. So for instance, for one of the NFT finance related protocol that we invested in early on, we actually helped them connect with all of the guilds in our network, as well as the guild who is directly in Tangent, which is Gabby representing YGG. So we connected them all the guilds, set up all of the user interviews and help them really refine their value proposition to their initial cohort of users. And actually through those conversations, they realized that the pain point that they were trying to solve for at that time, which is creating a credit facility for guilds, isn't as big as they thought it was. So they were able to pivot the entire company's direction based on that initial insight, even before we wrote our check. So that's a type of engagement we try to add on the product market fit side. On the hiring side, I think we also have one of the more powerful networks in crypto, not only from Daryl and myself and from our previous investment through our respective funds, but obviously through all of our founders as well. All of the founders also spread across a lot of different geographies. So for instance, Tasha, who's the co-founder of Alpha Venture DAO, is based in Thailand, one of the most well-known protocols in Thailand. And we also have Mabel, who's the chief revenue officer at StepN, who's a really respected voice in the Chinese community, even before she was at StepN and before she was at Multicoin. So we have a very global network as well that helps a lot with hiring. And I guess on top of that, we also have close relationships that we've established with law firms and audit firms that we trust, and also market makers. And this is because from a prior experience of investing, we realized that a lot of service providers tend to take advantage of newer founders that may not have that experience interacting with law firms or audit firms or market makers, and they get price gouged or they get offered things that are just non-standard and quite unfair to founders. So that's something that we can help founders look out for by making introductions to people that we've worked with before and people that we trust.
And what are your usual investment checks, the size of checks you invest?
Yeah, so because we do not have a collective pool of capital, so we are a loosely organized group of angels. So we're really flexible in terms of how much we can put into each protocol. I think typically our rule is we don't take more than 3% of any protocol. So if you're raising for a token at say like 10 million valuation, we're not going to take more than $300,000 because we understand how important decentralization is. So whereas a lot of the bigger VC funds might come in and just take like 10% of your network, which I think kind of, almost kills your network from day one and kills any semblance of decentralization. We think that's quite important. So that's the only rule that we have. But in terms of actual size, we're quite flexible.
So as well, can you tell more what mentors do you have in your group?
Yeah, I'd love to. So currently we have 6 mentors. So as I mentioned, we have Gabby, who is co-founder of the largest gaming guild in Web3, Yield Guild Games, and he's been incredibly helpful in shedding insight on what game models work, how P2E is going to evolve, and so on. We also have Sam Kazemian, who is the founder of Frax Protocol. So this is the only algo stablecoin that's actually worked and withstood the entire market crash, and they're the largest algo stablecoin today. As I mentioned, we also have Tasha, who's the co-founder of Alpha Venture DAO, who's actually one of the first DeFi protocols to come out of Asia back when they were called Alpha Finance. And then we have Mabel, who was a partner at Multicoin Capital, one of the most successful investment funds in crypto. And currently, she is working on a Stepin. So she helms a lot of our consumer-related type of investments. And we also have 2 anonymous operators in crypto. We have State, who is advising on mechanism design for SudoSwap, which is one of the more hyped NFT finance protocols today. And finally, we have Maki, who is the co-founder of SushiSwap and currently at Layer-0. So he's helping out with a lot of connections in the infrastructure layer. And it's just interesting because we are a very loosely organized group of angels, which means that the roster might change every 3 months. We review, okay, what does the market need right now? What do our founders actually need? And based on that, we might actually change out who's involved in the collective. And we're able to do that because we're not set up as, a traditional fund.
Mm-hmm. So as well, are you focusing on any specific areas within crypto blockchain, or you are like industry agnostic?
Yeah, so we're only focusing on Web3 for now. And I think we deliberately do not want to be very locked down by a thesis, because if you look back at the history of crypto investing, sure, there were 1 or 2 people who might have predicted that DeFi is going to be a big thing, 1 or 2 people that could have predicted that, okay, maybe AMMs would emerge in Ethereum, and maybe a few people that thought that, okay, maybe NFTs could be much bigger than just crypto kitties. But for the most part, I think a lot of the things that took off really surprised most people. And I don't want us to be limited by, a very limited thesis. So what we set out to do is only invest in things that we consider 0 to 1. So as long as someone is leveraging crypto economics in some way to bootstrap a 0 to 1 type of use case, we're quite excited for that. And in order for us to not miss out on potentially the next big trend, we also constructed our mentor cohort to cover every single vertical, right? So as I mentioned, we have Gabby for gaming, we have Sam for DeFi, Tasha for DAOs, Mabel for consumer, State for NFT finance, and Maki for infrastructure. So that way we kind of keep our eyes on everything.
So do you invest as well into equity, both into equity and tokens, or only into tokens?
We're pretty flexible, so we can do both. I think we have a strong preference for tokens because all of our founders involved in the collective have managed tokens before and have managed protocols. And we prefer to participate in governance, which is a lot easier to do if you have the tokens to vote. But we're pretty flexible with either.
So as well, VC investment is like long-term investment, especially when you invest like either both in equity or tokens that they are locked. So you don't really always need to time out the market now and to see what's trending now. You have to see to have a big vision what will be trendy like in 2, 3, 5 years. So what's your approach in that way? Or is it more like some kind of lottery, a game, and to see what will really take off?
Yeah, so it is not a lottery. So the way that we do it is quite different from a lot of venture funds. I think when venture funds have to allocate, say, 500 or $400 million, let's say, into different startups, they start taking a lottery mentality where they kind of spray and pray across a lot of companies, hoping that one of them will take off and make up for the losses on the other 99. So that's the traditional venture model that's especially pertinent in crypto, and that's something that we don't like. So we only actually operate a very concentrated model. We do not invest in more than 3 to 5 companies a quarter, which is probably 1/10 the number of companies that any VC out there would invest in. And we're able to take that risk because number one, we don't have LPs. It's all our own internal capital. If we take losses, it's our own losses. We're not really hurting any external investors. So we're able to take that concentration. And number two, we think that by being extremely hands-on with a handful of companies, we can actually create a lot more value than if we just spray capital around, especially because now capital really is a commodity, and good founders are very picky with what investors to bring on. And I think founders who understand the importance of a network like this really want us on board. And because we're probably the only fund out there that's not just indiscriminately investing in everything.
And what is your investment criteria? How do you select in which startups to invest and in which not?
Yeah, so again, I think our thesis is really broad. We just want to look for people with innovative use cases, but we focus a lot on the founder because of how early we are. A lot of our bets are founder bets, which means that we're not really betting on their initial idea because we know that after they go out into the market, they probably iterate a few times, and the final idea might not look like what they pitched us, and we're okay with that. But we need to be okay with the person we're investing in. So founder market fit is by far the most important thing we're looking for. So is the founder building this product because NFT is in vogue today, or are they building for DeFi because because that's the thing that people are talking about today? We really want to find founders that have a natural fit with the market they're in, who come from a background that really fits into that market. So for instance, we're recently invested in a protocol called Say Network, which is a layer 1 purpose built for order books. And the team came from, the technical lead of the team came from Robinhood, which is obviously one of the largest retail facing exchanges in the world today. So I thought that experience really crosses over really well into what he's been working on his entire career, as well as the skill sets required to build something like Say. So we're really excited to get involved with them. And those are the type of founders that we look for.
So regarding layer ones, what is your general opinion on new layer ones? Why do we need more layer ones? As well, there is another hyped layer one is Aptos, and their rounds quite differ. Like Say raised 5 million, and Aptos by this date probably raised around 350 million already.
Yeah, I think I saw the news yesterday with Mr. Labs behind Sway raising like 300 million or so. I might be in the minority here, and I'm sure some of the mentors in Tangent think different as well. But I do think the chessboard for most of the layer ones is probably set. I think the number of trade-offs that we could possibly make in that scalability trilemma have mostly been fully explored, and the proposed solutions to break out of that trilemma, things like ZK, are already in development, maybe a few years down the line. So I'm a little bit skeptical about generalized L1s that are not purpose-built for anything. So I'm personally a proponent of the app chain / app rollup thesis. I do think that purpose-built blockchains or purpose-built infrastructure makes sense for certain verticals or use cases. So like Say building a purpose-built infrastructure for order books, because no other layer 1s out there can compete, can offer that speed and latency. And unrelated dApps shouldn't be competing for the same block space that an exchange is competing for. Now, in terms of like general layer 1s like Aptos and Sway, I personally don't have strong views there. We're not involved in either. I think the general value proposition that people are espousing right now is that the Move language is great and it's easy to onboard developers, and there's formal verification. So maybe it's safer when it comes to smart contract bugs. But I think it remains to be seen just how much how strong a value proposition that is. I do think a lot of the traction between different layer 1s comes down to BD as well. It's like who can get the most developer mindshare, who can get the biggest apps to build on top of them. And we're already starting to see bidding wars between different L1s, bidding for massive Web2 applications to build Web3 implementations on top of them. And I think that will probably continue, and it's going to be it's definitely going to be one of the more saturated and competitive spaces. And that's why we don't really focus so much on L1s. We kind of make the assumption that, okay, the application, we'll just go to whichever L1 makes the most sense for them. But at the end of the day, the application still needs to have users. And we're focusing mostly on people building those applications that bring in additional users to crypto.
And in case of L1, so layer 2s, when new founders decide on which layer to build, what should be the decisive factors for them? Especially we see a lot of layer 1s, layer 2s, which have been run like maybe for 2 years already, and they as well raised quite a lot of money, but some of them are overhyped, a lot of new developers, new projects coming out on their chains, and some as well like do the same stuff around marketing, do hackathons, but still there is not that level of adoption. So what will you recommend for the founders? How should they decide on which chain to build?
Yeah, so I think there's two approaches. I think thinking back to the days when Serum was first being launched, I remember there predominantly being two schools of thought. So one is people just go to where the tooling is most mature today. So at that time, it was like Ethereum. So everybody was just building on Solidity and by extension, EVM compatible chains as well. Now, on the other hand, you had folks who were thinking, okay, if I were to build a exchange that processes say $10 billion a day, is Ethereum the right chain to build that on today? And I think the Serum team's answer was no, so they decided to build on Solana. So some founders would try to future proof it a little bit by building on chains that promise maybe different performance trade-offs than Ethereum. But for the most part, I think both schools of thought work. But at the end of the day, it really depends on the dev team themselves. What type of tooling they're most comfortable with, which team has the best documentation, and whether they think in the next 3-4 years the change that they're building on is able to support the business. And if not, do they have a plan to port over to another infrastructure stack that can support that business? But at the end of the day, I don't think apps are as locked into chains as people might think. Like I think the best example is DYDX, right? Porting over from Starkware over to their own app chain in Cosmos. Who's to say that that's not the way that most apps would go? Once they get enough users, they have all the leverage. The L1 no longer has any leverage over them. They can go and create their own app chain and probably retain more value as well. So yeah, I don't think the retention, the app retention that layer ones have is as strong as a lot of people think.